Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, March 21st, 2023. It's 2:15 p.m. Eastern Time. I'm starting the video. I'm going to cover the following in this order. We'll start out with, as I usually do, the equity markets. Take a look there. I'll try to show you a few new things I haven't covered recently, and just share my thoughts again where we're at. Once again, big FOMC meeting this week. Market's going to go either way, and they're probably going to go big either way. So, being long or short only the equity markets, you're either going to be very happy or very unhappy after the FOMC announcement tomorrow. But, as always, like I said, trade hedged, or as I like to say too, you don't have to be invested in the markets or anything at all really in a Fed week, especially rate sensitive assets, gold, silver, forex, all that stuff's going to move, bonds, all that stuff's going to move tomorrow, including the stock market. So just keep that in mind. Let me fix this trend line, which somehow just wanted to drift. Put that back where it was supposed to be, or where it was before. Okay, starting out here, obviously this one I've gotten out to you every day since Friday. We were right here on Friday. We had negative divergence right there, meaning the indicators are making equal or lower highs with prices making higher highs. Had that first leg down, hit the initial target. Remember, arrow breaks denote where you're likely to have a reaction. A reaction is defined as a consolidation and or bounce off a support level when you're on the way down. There's the bounce. As I said this morning, all that did is put in a marginal, meaning a slight new but still divergent high. In fact, the divergences continue to steepen. So that's that. Nothing's changed technically, and as I said this morning, the single most important thing at this point to watch, or what would give us the next sell signal, would be a break of that trend line. We didn't have that on Friday when I first gave you the chart because we only had a couple reactions. Being that we hit that initial target and bounce, that gave me that third and qualifying distinct reaction. In my book, it always takes 3 reactions minimum to validate a trend line, because any 2 points can be connected at random. So now you have a trend line, and like I said, that should start the party. We already hit the first target, which was that downtrend line. So the next leg down, which will be that, if I'm right, of course. Again, I'm going to be right or wrong, and the only guarantee I ever give you is that I'm going to be wrong, and I'll be wrong a lot. So, but if I'm right, we should see some profit taken really pretty much between now and tomorrow. We're at 218 right now. That's right about this time tomorrow. We'll be fresh off the FOMC rate decision. And so I suspect we'll see some profit taking, and then if things get really ugly again post FOMC, we have the potential to go down. Now it's not going to be straight down. They're going to be volatility, kickback rallies, or guess what? We go up, the divergences get taken out, we take out this previous reaction high, and then you're going to also at that point, even though this is just a little 60-minute intraday chart, if that happens, you're going to have the S&P 500 continue to, right now it's testing, but you're going to have it move away from the key primary bear market downtrend line and the 200-day moving averages. And so that's, like I said, it's not going to completely eliminate the case that we are in an ongoing bear market with more to come. More downside, that is, but it will certainly not help the near-term case for a leg down coming up this weekend into next. And again, just to reiterate, I've said it many times recently, unless we take out last week's lows, that's a powerful thing if and when that happens on all the indexes. So there we are. So right now, like I said, the most, I think the single most important thing to watch on the NASDAQ would be that trend line right there, the uptrend line off the lows. Quick look at ES, the S&P 500 futures. Remember, we have this trend line off the lows right here, that mid to late December lows. We've been kicking against it recently. You can draw it that way, and you're coming in then and catching the bottom here. That's certainly a fit, and then you have to give one little brief spike through there, and then that caps these two. So somewhere in here, it's these trend lines. There's been a lot of volatility lately. The VIX has expanded. I'm going to drag that trend line like this, move it, and just show you that we're, for all intents and purposes, we're still roughly right there. I'm trying to These trend lines can be a little finicky. There you go, got it now. So you can see it's still a pretty good fit. So we have a breakdown, a back test, and we also have at this point right here, at least on the PPO, we have divergence on S&P 500 futures there on the PPO, and so you can see a nice trend line there. And we could draw a smaller, little micro trend line. I'm not as crazy about this one, but that would probably coincide with a breakdown of that one I just gave you on NQ. So those are the levels to watch in the near term. But again, and this bears repeating, especially the week of the days leading up to, and especially the day, that 24-hour period left now between today, where we're at right now, and the FOMC announcement tomorrow, volatility tends to expand. Whipsaws are more frequent. A whipsaw is a false breakout above a break down below support, only to see it recover, or a breakout above resistance. So take it for what it's worth, and it's typically a good time to take some time off from trading, at least active trading. And if you're swing trading, you just have to decide where you think the market's going. I see a lot of the comments. A lot of people believe we're going to go up after the Fed, and maybe so. And maybe that's just recency bias, the bias of thinking that we're in a very near-term uptrend, so that's going to continue. But bigger picture, you can see since back here, we've been stair-stepping lower, and this is just in my opinion, a counter-trend rally in a bigger downtrend. Okay, some new charts, other charts, things to watch. Bigger picture, and I had a question put to me today. Or no, well, I answered it today. It might have been posted yesterday in the comment section. What makes you think markets might go down after the Fed? It's a combination of really, it was too much to put in that response. It's a combination of everything that I've covered over the past month or two in multiple videos. Taken collectively, market breadth, trend, long-term charts, trend lines, support resistance levels, key moving averages, different trend indicators. And again, I can make a case all day long to go long, to be bullish. I can also make a case to be bearish. That does nobody any good. So what I'll do is, if I think there's enough evidence, more evidence pointing to one or the other, then that's the one I will highlight. But like I said, if you want to play that game of glass half full, well, you can say here's the NASDAQ composite. Lately I've talked about how the impact that the market leading FANGs have on the NASDAQ 100 and QQQ, which a lot of you trade, or NASDAQ 100 futures, as well as the S&P 500 and or SPY. And it gives an almost an artificial distortion to how the actual stock market as a whole is doing, because just those top 8 top 10 components of the NASDAQ 100 and the S&P 500, due to their market cap weighting, can give a distorted picture of what the actual market itself is doing. So, for example, here's the NASDAQ 100 composite. I'm sorry, the NASDAQ composite. The NASDAQ 100 are the 100 largest stocks in there. And that is the very unbalanced market cap weighted index, where Apple, Microsoft, Amazon, Alphabet, Tesla, Nvidia, and Meta make up almost all the returns, just those handful of stocks. But you can see here, glass half full, you have a trend line. This is what I call a BOD, my BOD, or benefit of the doubt trend line, because you have that one distinct reaction low right there, 2009, second reaction right there in early 2020, and that's when COVID hit, and then most recently. Now, this is what I believe to be the primary bull market uptrend line, because it has more fits. You start at the same point back in early 09, and then you come in here and you have a lot more reactions. You had the fourth quarter 2018 drop. We started to go. That's where the Fed pivoted. That's the last time they tried a rate hiking campaign. Hiked a little bit, and then we're about to hike again, and the market threw a hissy fit, and the Fed, gave the screaming child who threw the temper tantrum what they wanted, and that was juice. Give the juice back. Turned around. Instead of hiking, they decided, okay, we'll cut rates again. We'll go back to zero. And then, of course, they just went all out nuclear when COVID hit. So there it is. You have a lot of reactions, and so it broke down there and it back tested. So that's glass half empty. meaning bearish scenario, that was, your primary bull market uptrend line. And here, I'll zoom in for you. Breakdown, back test, and that also coincided. See, we first took out the that minor trend line there, right there, sell signal. We took out the 200-day / 40-week simple and exponential moving averages. We back tested them there, rejected, and that's typical of a bear market. Now we're really testing them. We're right on there again. And here's what I wanted to point out. So on the NASDAQ Composite, which again is more inclusive, it is all inclusive, if you will, of all the stocks that trade on the NASDAQ. That one is at its primary bear market downtrend line now. You have that highs right there. I'm sorry, the high, couple reactions right afterwards, and several reactions since. And you can see again, we're pretty much effectively still testing. We haven't clearly taken them out enough on the downside to say that's a hard rejection, like that rejection and that rejection, nor have we moved up above enough. So it's, again, I think we're in a make or break technical juncture for the markets. Is it possible to continue to flounder around on the 200s and 40 weeks for a while? Yeah, it's possible, but it's unusual. This market's probably going to pick the next direction, and then you have these previous lows again. If taken out, you'll also take that trend line out. So that's what the composite looks like. You can see a fib up. This yellow line measures the whole entire bull market off the 2000 early 09 lows to the highs, and you can see perfect 38.2, which is really a minimum run-of-the-mill correction, or in this case bear market target. Typically you're going to run down to the 38.2, 50, 61, sometimes even the 78.6 fib, which would be down here somewhere. All right, now just wanted to show you, compare the two. So there's the NASDAQ 100, but when you put the fangs in there, kind of a busy board here. That I will say I have alternative trend lines, but let me just keep it very simple here and draw it out for you. There's the that would be a potential downtrend line that can form if we hit it there, but the way I have these drawn right now on the weekly chart, you can see I had this one right here. That was the downtrend line I used on QQQ. Comes off here, and you have the most reactions right there. You have 1, 2, nope, 1, 2, 3, 4, and then you recently took it out and you're trading above that trend line. Again, you can sit here all day long, draw a different one here, and come in right there if you want. Hard to argue, but when I go to all the other indexes, Wilshire 5000, you can see just like the S&P 500, and remember the Wilshire 5000 is probably the most indicative of the stock market, including all different market caps, and all that doesn't have the impact of the top components. But the Wilshire and the S&P are really more indicative of the overall stock market, the entirety of all the different sectors and stocks, and also of more so of the economy, if you will, if you were to believe that the stock market is the economy. It's not. Sometimes there's a disconnect there, obviously. And again, you can see here it's just cross currents, breakout, back test, and we're still there. Did we fail it? No, not yet. I told you it's incremental. You got to go down quite a bit to say it's a failure. And is it a successful back test? Well, not yet. If we start moving away from the trend line after back testing, it will be, and especially when we take out that high. So that's the Wilshire, the S&P, and I wanted to show you one more thing while I'm on this board. So there's the S&P 500. Get the downtrend line, breakout. Looked to be maybe a failed breakdown, but we didn't go over low enough, and we're right on. If you zoom in right there, you can see that red line. There's the 200-day / 40 week. On a weekly, it's the 40-week moving average, same as a 200-day on a daily chart. There's a 200-day simple, and that's what's capped, typically caps bear market rallies like it did there, and there. So that's it. I can sit here all day long, been saying the same thing. One thing that I haven't pointed out, told you I'd give you a few new things. Let's put up the PPO histogram right here. And you can see there are a couple things to note. I think I did cover this recently. you are typically in a bear trend when the PPO signal line, the 9 EMA on the weekly, is below the zero line, which I just highlighted here, and we remain below, and that level often acts as resistance when tested from below. So you have that. And again, that's why I think we're at a make it or break it level. If we can start to power up, you're going to get a bullish cross of the PPO over the, and again, it's the white line I use because that's the last of the two to cross. It helps filter out whipsaws. The PPO line, the blue line, is faster. The 9 EMA is the slower of the two. And so you have that, and look what you also have. The PPO has made a bullish crossover back here. Throughout this bull market, or bear market so far, I've highlighted upcoming and then confirm when they happened, both bullish and bearish PPO crossovers on the daily as well as the weekly. The weekly is a little better for you swing traders and trend traders, and so that said, hey, you know, we had a crossover there, and the trend overall has been bullish, not very, but we've risen since that point. It's been a slow climb, again, not very big. And so if you look here, we're poised on any more downside. We've flirted with a bearish crossover for the last 2 weeks now. I think you can see that in the video. Those tiny little specks were 0.2. So what happens is when all these indexes, and you want to see all of them, now the NASDAQ 100 has been a lot stronger. If we get a bearish crossover, it's going to come, and it's going to come after a pretty good pullback, pretty good amount of downside from where we're at. I'm just going to show you where we're at on all these. So there's SPY, the S&P 500. Again, weekly. All that matters is how you close the week. Here's the Wilshire 5000. Already, as of right now, you have a bearish cross. It's at negative 0.01. And little tiny red bump there. So again, doesn't matter that it was crossed right now. The signal will be confirmed at 4 p.m. on Wednesday because this is a weekly chart. IWM, your small caps, clearly we had a solid bearish PPO crossover last week, and it remains there today. We're also below both the 200-day moving averages, but the small caps, as you can see on this weekly, like everything else, back testing, breakout and back tests of the bear market downtrend line. So you're below the 200s. Again, everything's in close proximity. That's why I keep saying it's make it or break it time for this market. If the bear market ended here and we're going to go up anywhere near or above the all-time highs, then this is where they really should be stepping in from a technical perspective. And if they fail it, that's going to be very bearish. And that's still my preferred scenario. I made that very clear, but it doesn't guarantee it's going to happen. It's just what it is. Mid caps, MDY clearly made the bearish crossover recently. You know, here you have bearish crossovers here, right when the market topped. Bullish crossovers. Again, they're just trend indicators to use. And then finally, what I covered, small mids. Oh, QQQ. QQQ, you can see very green. But when you look at either the NASDAQ composite or QQQE, that's your equal weighted NASDAQ 100. You can see that's telling you a different story. It's not a, it's a little bit comfortably, it's somewhat comfortably above the zero line now, but one or two bad weeks would take it down below. You know, we were at that level there, and then by the next week you see we had a crossover there, so we could cross anytime. And again, this just shows you what I'm trying to impress here is that it's just that rally really in those big mega cap market leading FANG stocks that's doing most of the heavy lifting now. And again, historically, that's not a good sign for a stock market rally when only a handful of stocks are doing all the heavy lifting. It shows you that underneath the hood, meaning market breadth, as I covered extensively in a video recently, all's not as well. Alrighty, let me give you a few more things. Let's see. All right, enough on that. Let me park this. Let me go to the VIX. Mr. VIX here. Where are you at? I'll use my VIX futures. That's right here. And we are still, this is that 2-hour chart, 120-minute candles that I've been showing you. There was our divergent low right there, positive divergence building for a while on the RSI. Breakout was highlighted there as an objective reentry after the breakout, and we pulled back to this area here several times. We're still above the trend line. So the VIX is, bottom line, the VIX is still elevated above recent levels. It's still on breakout mode. The breakout hasn't yet failed, and this is the market waiting, kind of went in a holding pattern in front of the Fed. Gave you this chart of the VIX here. This is the daily chart. You have that downtrend line. It needs to pop right there. There was a long-term uptrend line which we rallied off of, so there's support. We're really pinched between support, meaning the uptrend line, and we're comfortably above that right now, and then resistance being that downtrend line. So really, whichever way this triangle breaks, the market's going to break one way or the other. If the market goes down, the VIX is going to probably do this and shoot way up, especially if we take out if it's going up here or higher, we're going to have to take out, we'll most likely take out the previous bear market lows back from mid-October. But right now, like I said, a start would be to see the markets take out last Monday's lows. Okay, and the other things I'm going to update in this video, we'll go to gold, silver, crude, natural gas, coffee, and wheat. Let's start with gold right here. Oh, there we are. We're right on that level. Now, okay, so that's that first support level, first target. Said would likely be hit before the Fed meeting, and following this breakdown, that was it. So I covered this one the other day, and we were making walking up with this uptrend line, had negative divergence there, and broke down sell signal. And I think silver should also be up on support. So that's it. Divergent high, negative divergence, correction. And let me show you silver again. From where we go from here, it's a good chance, good place to cover when we hit that target, because the Fed's coming up. The market's probably going a holding pattern, maybe a little more downside in silver. I have more of a support zone, runs from that's 22,134 to 22,223, and we're very, very close now. All right, and then look, if those levels get taken out, these are nice clean wedges, divergent highs. You can see that on silver especially. Silver tends to fall harder than gold during a sell-off in the precious metals, and so the way it works is likely get a reaction on the initial tag there, but based on the measured target for that wedge, we could come on down. You know what? I need to give you one more level. I think that might be a pretty aggressive second target, especially with the euro still in breakout mode. I'm going to put a level right here. Yeah, I like that one. 21.79. That's where I put good odds that that's silver will probably make its way down to a minimum, and then might provide a buying up. We'll see. And if it comes down here, that's even better. That's even better support. Okay, next up, crude oil. I told you yesterday I took crude oil as a hedge, what I call an indirect hedge to my index shorts from the swing accounts, which I'm going to, as of now, everything's looking good. I'm going to take those into the FOMC meeting, those swing shorts. Plenty of room to add, but I want to mention that crude right now is at the first resistance level. I didn't have a lot of targets. I gave you this one up here. That's 72.59, and the potential downtrend line. I call it potential because there's only two reactions so far. We need a third confirming, so that may or may not come into play. That's pretty decent price resistance, nothing great, but we are at the first level there. So since the breakout, actually broke out about right here. It's been about nothing big, about a 3% rally in crude, but it's more than offset the gains in the NASDAQ 100 and since then. So anywho, that's what crude's looking like. Probably draw a little uptrend line here as well. May want to work its way up, but I want to just put a line right here because we are at resistance and just add it right at that previous reaction high. Traders like to look at those reaction highs. So, and still coming off a pretty strong divergent low. Pullback or not, we'll probably see some more upside in crude. But again, this is also this kind of on and off a dollar sensitive asset, being that crude's priced in US dollars, at least this WTI that we're trading here, and it all can go a different way come tomorrow at 2 p.m. So good time, if nothing else, to maybe take some quick profits, lighten up, but also not a great time to start taking new positions right in front of an FOMC meeting. Okay, nat gas, that one was thrown out here recently. We had a pretty decent support zone there, but we took that out. We broke down, so that was pretty much a break of support. Tried to rally, got rejected below, and it's still, support once broken becomes resistance. So now you have dual resistance level. You have a confluence of resistance. You have this downtrend line right here, and if I didn't mention it, I'm on the 2-month chart showing hourly candles, and so that's what nat gas needs to break, that break above the downtrend line, that resistance zone. We just put in another divergent low here right now. You can see positive divergence there. We've been building some divergence here on the PPO. That shows through on the daily. I'm going to show you a long-term chart in a second. And we reversed just right around that previous reaction low right there. And again, traders look for these pivot lows as potential support levels. And so far they bought it up. But that's it. So where it goes from here, we've got to break that level. Let me show you a long-term chart. Okay, this is a daily chart of natural gas futures. It's an EOD or end of day chart. That's what stock charts gives you. So it's not reflecting today's prices just through the close yesterday. But a couple things to note. As pointed out recently, we did have a divergent low, a positive divergence. We did have a rally off there. And then right about this time here, when we hit this oversold reading a couple weeks back, I showed you how natural gas, I'm going to show you here in a second on the weekly, quite often ends the big legs down end with positive divergence on the weekly. This is just the daily. Point being that we hit a roughly equal low, reverse almost right above that low I just showed you on the 60-minute chart. So really today's candle should be about right there. And so it gives you that divergent, or what I call ADL, almost divergent low. Let me show you what it looks like on the weekly. Okay, here's a weekly chart of natural gas. We're going back to 2008, and you can see since that time there have been just a handful of call them meltdowns. There was one of them right there in natural gas. There was another one there, one right there, one right there. So again, we're going back, quite some time there, well over a decade, and you've only had 1, 2, 3, 4, and now 5 comparable drops that all took natural gas down to below this level right here, this line about $2.50. It's rare to see nat gas or down to or below that level, and so this was one of them. And what I was saying before is, and this is what I covered about a month or so ago when we first hit this level, that I pointed out, hey, we're oversold on the RSI, but quite often it's that you have that initial drop. Let me clear all my lines and reset and show you. You have that initial drop down there, and then a slightly lower, an equal or slightly lower low. There's 1, 2, 3, 4 right there, and you had divergence on one or both of these indicators here. Well, sorry, that one right there. There it is for that one. Right there. And so now, again, this would have come down to there today. If we can reverse or even go down a little lower, that's fine, as long as you still make a higher low here in the RSI. PPO's just way down here. So that's it. And one thing, remember, natural gas, unlike Silicon Valley Bank, or unlike Enron or anything else, isn't going to go and declare Chapter 11 bankruptcy. It's not going to fail. It is a commodity. It will always have value, and so it's not going to zero. And all I can tell you is there's no hard bottom, you can see, but typically when you get down to under $2.50, $2.50, then that's usually you're very near the bottom. So that's it. So we'll keep an eye on it. Like I said, maybe the bottom's now with that positive divergence that we just put in. Maybe we make a marginal new low, but I did give you the takeaway is there's some levels you need to see get taken out above on natural gas futures. And then if you look at UNG, same thing. You can see here, there's the weekly on UNG. You can see we're at that 822 level. Daily chart, let me zoom in a little tighter. There it is. If I put that line, there's a roughly equal low right there. See that positive divergence now is in play right there. And so you had downtrend line I gave you on natural gas futures. Natural gas futures I like a lot better, especially with charting, because you're seeing the round the clock trades. And there's that same, that was support right there. It was also our short target here, T1, T2. And so we need to pop that. And then we can run up there, hit T1, T2, T3. Those would be your minimum targets. But if that starts to pan out, then you're maybe looking at one of those, just like on that weekly chart I showed you. These were the bottoms in natural gas, and they started multi-month or multi-year rallies from there. So that's natural gas. and kind of nibbling my way back into select, but you got to be select on commodities. We're not back yet at this point in time in that broad base commodity rally like we saw coming off the 2020 lows, first leg up in the bull market. It's more of a selective hit and run. So, coffee recently we shorted somewhere after this divergent higher, that trend line break there. We had that bearish rising wedge. We hit the sole price target right here. So support resistance zone, and then we recently went long, and it's up a little bit, nothing much, but it's still, I still like it. It's still coming off, long at support with positive divergence. Those are trades I take all day long. Pullbacks to support with positive, aka bullish divergence, but we still need to pop this level right here, 183.76, and that should open the door for another leg up. And for those of you that don't trade coffee futures, which we were just looking at the KC, you can use Joe. And Joe, the basis for that was that pullback. That's that same short pullback target. There was the bearish rising wedge, breakdown, pullback to really good support, and so you have resistance here at about 57 and a quarter. Need to pop that, and it should take us up to the next leg up in the bull market. PPO looks constructive. There's that PPO zero line right there, and when you're below it, the white line, the signal line, the trend is bearish, and when you're above it, as you were right here, really, the trend is bullish. And you've been above it all this time here, and you're still above it. And the PPO, like I said, often the zero line often acts as support or resistance when back tested, and that's what you're doing. So if this goes to plan, or the way the charts look, we should come up here. PPO should turn up, and we should get the next leg up. And then wheat. Somebody inquired about wheat the other day. Let me give you my my reply. Okay, this was Friday under that NASDAQ 100 moonshot trade post. Somebody asked about wheat, and I said, just noticed the bearish rising wedge pattern on the wheat 60-minute chart as it approached the 715 level. Not crazy about the charts of the other two big grains now, so just wanted to pass that along. And I'll revisit the charts of the grains once the FOMC rate decision is out of the way next week. So that's the chart I gave. That's a textbook looking bearish rising wedge pattern. Remember, we had a bullish breakout recently, and but we just can't seem to get going. And when you got to look at, this was big divergence too, negative divergence. So, and that was on Friday, and since then that went on to break down, and that would have been a sell signal for wheat, or was. And ZW, that's what it looks like now. So let me just make sure that's up to date. The same wedge, same chart, unedited since then. Breakdown, and it's been moving lower. The wedge has pretty much met its measured target, so that's my guess is that's probably it for wheat. But again, I'll revisit this and the other grains and really commodities as a whole once the Fed's out of the way. We'll see which way the market is going to break, which way the dollar is going to break. Remember, we had that euro. Euro was bullish the other day, right in front of the ECB rate hike. You had a nice clean uptrend line, positive divergence, and it's moved up since then. But let me show you what it may be telling us tomorrow. This is indicating potential weakness. You have negative divergence now with the euro rallying up to or just below that resistance, that 108.78. This is E7, by the way, guys, if I'm talking fast. E7 or the euro future. Same chart I showed you last week on Thursday or Friday. Oh, no, Wednesday. I think it was Wednesday, yeah, because the ECB rate decision was the Thursday morning, I believe, if I'm not mistaken. And anywho, so that was that. I took that one for a quick bounce, but I got out. I got out right before the decision, and that's it. So if this divergence plays out, minimum probably take us back to the trend line, but I think there's a decent chance that could break. Now, what would cause that? Almost certainly, or most likely, a more hawkish than expected Fed. I don't think they're going to give us, I would almost bet the farm they're not going to give us 50 basis points. 25 is baked in the cake, and so that's probably what we'll get, but it's all about what Powell says afterwards. And so just keep that in mind. If the euro breaks down, that's going to put additional pressure on gold and silver, probably take you to those deeper targets I just gave you at the beginning of the video. However, if we stay above this trend, and if the Fed's more dovish than expected, the euro can continue to rally, and then gold and silver should resume their uptrend. But again, it's gambling to take big positions in anything, not just the stock market, but anything that's likely going to be impacted by what the Fed does tomorrow. So, probably a good chance if you got those profits, hit those early targets in gold and silver, take profits. You can always get back in afterwards. That's it. Let me wrap it up here, get the video out to you, and we'll pick it up tomorrow. I'll certainly give you my thoughts after the Fed. Anything between now and then is just noise, in my opinion, including breakouts or breakdowns. I'll take a breakdown on that, NASDAQ futures on face value, but like I said, swing trend positions, I've got what I need to have heading into that. I'll just wait until after the Fed meeting, and then I'll make a decision whether to scale out of those swing shorts on the indexes or add to those. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.